Hello, everyone. Today on the final bar, Jesse Felder will be joining us on the show once again, sharing us some charts addressing the inflation issue, which has felt less transitory and more real and more extended. We'll see what the charts tell us as we review those together in a bit. The S&P overall finishing a little stronger today, closing right around 4,700, but showing some distribution going into the close. Cryptos as well in distribution mode. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us after the close every day as we review the top charts and focus on the analysis of market trends using the power of StockCharts.com, using data visualization techniques to understand investor psychology and where the trends and momentum are. Overall, this environment has, I would argue, continues to be in a position of strength. The S&P continuing to push higher, the NASDAQ pushing higher as well. I did a webcast earlier this morning on the small cap space in particular, lagging behind a bit, but overall, sort of everything moving to the upside. But you're seeing a bit of a disparity right now between stocks continuing to push higher and quite a give back in the cryptocurrency side. We're going to look at the chart of Bitcoin, maybe Ether if we have time for it as well, and talk about the pullbacks that we've seen in the last 24 hours and what sort of lines in the sand we want to pay attention to. Overall, this day is sort of a risk on versus risk off day. You look at the top performing sectors, it's the growthy stuff, things like consumer discretionary and technology leading the market to the upside. Let's overall look at the conditions and focus on some of the key stocks reporting earnings this week. Home Depot, Walmart, top of mind today after reporting before the open. We have great guests on the show. I'm excited to talk to Jesse Felder here in just a little bit. The remainder of this week, on Wednesday, the 17th, we have Javed Mirza. He's the technical analyst at Canaccord Genuity in Toronto. On Thursday, the 18th, Wyckoff expert Bruce Frazier from Wyckoff Analytics and host of Power Charting on StockCharts TV will be joining us. Next week on Tuesday, we have Mike Siccardi joining us on the show for the first time. He does a fantastic job on social media, which is where I first connected with Mike. I'm excited to have him on the show next week. And then we'll be taking Wednesday through Friday off for the Thanksgiving holiday. Hope everyone is able to celebrate safely with those around you and those you love. And we'll be back with you the Monday after the Thanksgiving holiday. Let's continue on with our market recap. We're going to start with a poll. We always have a poll going on our live stream page at stockcharts.com/TV. But you'll also find it on our social media accounts. So make sure you follow us on Twitter, on Facebook, and elsewhere. The question we asked you recently: know your technical indicators. Which indicator is based on the difference between two exponential moving averages? I am very proud to say Final Bar Nation crushed this one. 82% of you correctly answered the MACD indicator, which really stands for Moving Average Convergence Divergence. It is driven by the difference between usually the 12 and 26-day exponential moving averages. Take a 9-day average of that. That's called the signal line. And that is really the essence of that trend following technique. And people use it as a trend following tool. They also use it to measure momentum. There's a histogram that shows the difference between those two lines. And that's something that we have on our charts as well. The PPO indicator that I use often is very, very similar to MACD. A couple of you answered incorrectly. Stochastics, RSI, Bollinger Bands really are not based on exponential averages. Stochastics is notably doesn't have any exponential calculations. A very simplistic calculation of where we're at relative to highs and lows over a period of time. Bollinger Bands are based on a simple moving average and then standard deviations. RSI does have an exponential calculation, but it's not based on moving average really, although you could argue there's some sort of input there. But MACD is correct. And if you're not clear, if you didn't answer that correctly, if you want more information about any of those indicators, our chart school pages are really the place to look. That's a free resource on StockCharts. When I was studying for the CMT exams, I used the chart school feature on StockCharts to review some of the indicators and make sure I was prepared for that exam. So I'd encourage you to check it out. Continuing on with our market recap, I mentioned the S&P closing right around 4,700. That's up about 0.4% from where we closed the day yesterday. A bit of distribution in the last couple hours of trading, but overall finishing higher than Monday's close. The Nasdaq almost over doubling that. About with the Nasdaq Composite up 0.8%, just about. Small and mid caps both up in the positive, but not as much as the S&P. And the VIX is a lower today, around 1640. Looking elsewhere, interest rates pushing a little bit higher. So the 10-year yield up to around 163. Yesterday was quite a move from 155 up to 160, 162. So overall, we're continuing this move of higher rates, and overall that range like 150 to 175 is where we spent a lot of time earlier in this year, sort of in the March-April timeframe, and then came off there and bottomed down around 115 for the 10-year yield. Now back up above 160. And it's not too much of a surprise, hopefully shouldn't be, given what the Fed has suggested they will be doing here going forward. Rising rates certainly seem to be an environment that I think I would be mentally prepared for if you're not prepared for it just yet. Dollar index up just a bit. We're using the UUP up around 0.4%. Gold and precious metals, both gold and precious metals down today, with the GLD down 0.7%, silver ETF down 1.2%. Oil prices up a little bit, and the energy sector was flat for the day. Cryptocurrencies, where you're seeing quite a bit of movement and overall very much to the downside, with Bitcoin down over 5% from where we were at yesterday as we were recording the show, with Ether down over 7% over the same time period. Let's look at a chart of the S&P 500. We'll look at cryptocurrencies. I know I'm going to talk with Jesse Felder here in a bit about gold prices, so I'll probably save that for our discussion there, but let's start with stocks overall. So as we've talked about, right, I think, I tend to describe the market as where the path of least resistance is, right? And it really goes to the basics of trend following. Your goal as an investor, I would argue, three purposes. Number one, or three goals. Number one, identify trends. Number two, follow those trends. Number three, anticipate when those trends are exhausted. And if you can do those three things consistently, overall, I think you're going to do pretty well as an investor over the long term. So what is the path of least resistance for stocks? Well, it certainly seems to be higher by the fact that we've continued to see higher highs and higher lows. And I think over the last 6 weeks, we've seen the pullback into the beginning of October, down about 6% from the early September peak. We then regained that level around 45.50. That was in mid to late October. From there, that's the first line in the sand. And I tend to suggest you start at the current bar, the final bar, you look to the left and see where we're at relative to some key levels. And if you want to understand where the risk may be to, or what support levels may be to anticipate, look on the chart to see when we've experienced some previous turns. So I would argue that first level is 45.50, and not too far below that, the 50-day moving average is around 4,500. So that would certainly be a reasonable downside objective if you would see any sort of pullback materialize. That would be the first level, the first line in the sand. And the way that I think of it, the path of least resistance appears higher. And if we would hold that on any pullback, that remains in place. If and when we would break that 45.50 to 4,500 range, then I think you need to start thinking about more downside potential and what that would do to a portfolio, to your charts, to the holdings that you have, the charts that you're following, because what that tells you is that there's certainly more downside potential. There's an elevated risk of going down much, much further. On the chart, again, if you look to the left, I think you have another clear support level around 4,300. That's the low from mid-September, from early October, and the 200-day moving average is right around that same level as well. So investing is never easy. I don't want to describe it that way, because this is a challenging game we're all playing. However, I mean, in a time like this, it certainly seems like you have clear levels indicated, and you have a clear trend in place. And the market overall is telling you that the markets are going higher. The most bullish thing the market can do is go up, as I was told by one of my early mentors. Now let's compare the chart of the S&P, where you're seeing further upside potential, to some of the cryptocurrency charts. Now, again, these aren't horribly broken relative to where they've been, but you're certainly seeing some distribution in the last 24 hours. Bitcoin got back below 60,000. It had gotten above there for the first time. Well, that's not true. The first time was earlier in the year, but first time in the last 6 months. Once you recovered that 60,000 level in early October, we've gone above 60,000 there mid-October. We then made a swing high, pulled back a bit but then rotated, made a new all-time high, nearing that 69,000 level in early November. Now we're starting to pull back a little bit. And again, I tend to think of the market in terms of swing highs and swing lows and how those patterns are progressing. On Bitcoin, you have a pretty clear level here around 58,000. That's the low from late October. That's also the 50-day moving average right around 58,000. So we're near that point of potential support. We're arguably touching it right now. And so I think holding that 58,000 level would be pretty key. Breaking that, and you have to start looking deeper at some further retracements. That's when I would think about Fibonacci retracements and start to identify some other levels, maybe tactically, if we would progress a little bit further to the downside. But overall, we're sort of in pullback mode of sorts, and we'll see if those levels are able to hold. If you look at Ethereum is a little bit of a different chart. Bitcoin is interesting because it's showing a bit of a bearish momentum divergence. We've seen a couple of those, and once they've completed that divergence pattern, you've seen pullbacks a couple times already this year. And I think Bitcoin is a bit risky at this point, just given that potential configuration playing out. Ether's a little different only because it's just breaking above the highs from earlier this year. We had a high in May and again in early September. We're just getting above there and now retesting the breakout levels. So sort of holding this 4,000 level, which is a big round number. That's right at the 50-day. That's the low from the end of October. Would be sort of important. So with both of these, you've pulled back quite a bit here in the last 24 hours, but remaining above those levels of support, I think keeps a bull thesis in mind. You break down through those levels, and if I were you, I would start thinking about further downside potential to be had. That's all the time we have for the recap. I feel like when we get into the charts, the recap flies by, but we need to take a break and we'll be back with today's guest, Jesse Felder. We'll see you back in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So good to have you join us every weekday after the close for our show. We're going to get to today's guest, Jesse Felder, here in a few moments. A couple quick announcements before we do so. Number one, we're going to do a mailbag segment a little later in today's show, and we would love to answer your question on the air in our next mailbag segment on Friday's show. You can get your questions to us a couple different ways via email, thefinalbar@stockcharts.com, on Twitter @FinalBarSCTV is our handle there, or on YouTube. Just go to our Stock Charts channel, put a comment below the video you're watching. We'll gather all those questions and hope to answer yours on our next mailbag segment on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. Great shows like The Final Bar, fantastic guests like Jesse Felder and many others, special events like The Pitch, our year in review coming up in December, all of that, much, much more from our website, StockChartsTV.com, or on your mobile device, just search on any of the app stores for StockCharts TV on demand. I want to welcome on today's guest, Jesse Felder. Jesse's been on the show a number of times before. It's always a pleasure to have him on. He's the editor of the Felder Report, coming to us also from the Pacific Northwest in Oregon. Jesse, welcome back.
Thanks for having me, Dave. Always a pleasure to talk with you.
You as well. It's good to see you. We're, obviously the rising rate environment is something that I know a number of investors are sort of struggling with. We really haven't seen that sort of behavior for too long, and now it's starting to be a reality, and certainly the expectations going into the next year are for more of the same. Start us with this chart. We have the tips and the GLD. What are you seeing here?
Well, I try and combine multiple disciplines. I first was a value investor, and so fundamentals are key to me. Difficult to figure out what are the fundamentals that drive gold prices, and typically that's real interest rates. When real interest rates are falling, that's typically very bullish for gold prices. Negative real interest rates are very bullish for gold prices, and tips are kind of a shorthand way to decide which way are real interest rates moving. So rising tips is suggestive of falling real interest rates. So typically, you can see these things are typically very highly correlated. Gold kind of got ahead of tips back in summer of 2020 and has been in corrective mode since then, but tips have just continued to power higher. in recent months and in recent weeks just broke out to new highs. This kind of suggests to me that the fundamentals for gold prices are really strong, and that gold price should probably break out, test new highs and break out potentially over the next few months.
And, one of the critiques I've had of the GLD and of gold is just you really haven't had the breakout yet. But, arguably, as you mentioned, the last week or two, you really are starting to see things emerge. Now, I know the question for a number of people when you're looking at gold is, do you buy spot gold or a gold ETF, or do you buy gold stocks? Talk us through chart number 2.
Well, within the gold space, whether it's, GLD, CEF is another one that I watch pretty closely. It's gold and silver prices kind of combined. I'm seeing a number of these inverted head and shoulders patterns. It's suggesting that they're in a bottoming kind of phase. This is the ratio of the gold miners to the gold ETF, GLD ETF. And typically miners, are just a higher beta version of the precious metal. So gold prices go down, miners go down faster, and vice versa. So if gold is in the process of reversing, breaking out and going to be potentially pretty strong over the next few months, gold miners are suggesting that they could reverse from outperforming to the downside to outperforming to the upside. It could be a good vehicle for playing the trade.
And right, so this is a ratio looking at gold miners over gold. So if this is going higher, gold stocks outperforming spot gold. It's going down, gold stocks are underperforming. So suggesting that gold stocks may be poised to outperform. Is that the way I would think of it?
Absolutely right. And fundamentally too, for me, the gold mining stocks are about as cheap as they've ever been relative to the S&P 500. So I like to combine those things. I like to find things that are cheap, but also show technical signs of reversing higher. And I think that's what we see right now.
So gold is one of those spaces. We have just a minute or two for questions, if we could, Jesse. So,
Sure.
Gold is one of those spaces that's sort of been underperforming for a little while. It's sort of a beaten down area of the market compared to others, but starting to rotate higher. Other parts of the market obviously feel a little more overextended, right? And when you look at the S&P making new all-time highs recently, the NASDAQ as well. Can you share with us just your big picture view? Is this an environment where it feels more risk on going through year end into beyond, or is there a reason to think more defensively when you're looking at the environment here?
Well, I put together a custom index. It's one thing that I'm paying close attention to, of just a number of meme stocks. I call it my stonk index because, it's got GameStop and AMC and a bunch of these really popular retail favorites. And it's something I'm watching closely. It peaked back in February, tried to make a new high over the summer, wasn't able to, and tested that summertime high again over the last couple of weeks and was reversed lower. So to me, that's a really good measure of risk appetites. I'd want to see that breakout higher as a sign that retail investors are still interested in pouring money into the stock market, because if that retail sentiment turns, that's probably a bearish sign for the broader stock market. So I'd pay close attention to all of the highest beta type things. I'm looking at Robinhood is another stock that's in that measure for me. And so all these indicators that are kind of good sentiment indicators of the broad stock market are ones I'm watching pretty closely right now.
That's a great take, Jesse, and small caps as well, right? Just starting to break out, see if those are able to sustain as well. Listen, it's always so good to have you on the show, Jesse. Really appreciate you sharing some charts with us and your expertise as well. Stay safe, be well. We'll talk to you again soon.
You too, Dave. Thanks for having me.
That's Jesse Felder. Jesse's the editor, the founder of the Felder Report, comes to us from Oregon. Does such a great job. I love his way of just thinking of the market environment, particularly with gold. Gold's one of those areas where I feel like we talked about it very little. And if we did, I probably talked kind of negatively about it, because it's one of those where the relative performance had just been so underwhelming. And as you can see from some of the charts that he shared, there's a bull case for gold all of a sudden, which I don't think had been the case quite earlier in the year. But you're really starting to see the bull case for gold and reflected in the charts, which is what's most interesting. I like that ratio, by the way. That's not one that I tend to follow too often. And in my Fidelity days, we used to look at the gold stocks versus gold spot ratio. So I'm going to add that to one of the chart lists here very, very soon. That's a great take from Jesse Felder. Let's continue on opening the Final Bar mailbag. As a reminder, all of our questions come from you. Our email is thefinalbar@stockcharts.com. We hope you take some time to email us your questions, and we'll hope to answer yours in our next mailbag on Friday's show. Let's get to it. First off, Joe Duarte said when he sees the advanced decline line moving down and on balance volume moving up, that smart money is moving in while short sellers are coming in. So on this PayPal chart, it's the exact reverse. What does that mean? And you sent this chart, I think. Yep, this is the one that you sent. And thanks so much again. When you're asking a question, if you send the permalink that's below all this, the charts, there's a little link right there. If you send that along with your question, it's very easy to look at exactly what you were looking at when you asked the question. You're referring to Joe Duarte's guest appearance on the show, which was last Thursday, if I remember right. He did a great job just talking about the overall environment, stronger advancers, decliners as a breadth indicator. But we looked at one particular stock, and he made that point, which actually was an interesting one. I went back and watched the episode again just to hear his comments on it. And his comment was, when you look at the advanced decline indicator versus the on balance volume, it can tell you. He was making some inferences about whether it represented short selling, and that would actually be causing some of the volume. Really interesting example, and that's not the way I've normally tended to use it. I've tended to use the advanced decline line and the on balance volume as similar takeaways, right? You're looking overall at institutional momentum and where the volume is. So in terms of your chart and your question, first off, you were actually using what's called the candle volume charts, which I don't know if we've ever actually shown on the show before. So I am thrilled that that's what you did. If you have seen equivolume, that was an idea where the width of the candle or the width of the bar is representing the volume. So a heavier volume day has wider horizontal space. So it accentuates the big volume days. It's a great way to look at the price volume relationship all in the chart. Dick Arms, who sadly is no longer with us, but I met him a number of times years ago when he came through Boston, and we had great discussions about candle volume, which is something he had created, which was basically embedding the candle patterns, looking at open, high, low, close within the equivolume chart. That's what you're using here. So I love that. And if you're not familiar with that, search for Dick Arms' candle volume on StockCharts and you'll find it. So your question, I think, is referring to the bottom two, where you're saying this is the opposite, where you have higher advancers, decliners, and lower on balance volume. And the problem is you're actually not looking at the advanced decline indicator. You're looking at ADX, which is Wells Wilder's indicator called the average directional movement. This is actually a measure of trend. So what this indicator is telling you is the trend is strengthening. The on balance volume going down is telling you that the volume is basically stronger on the down days, and as a result, it's a strengthening downtrend. The chart, obviously, the price of the chart is showing you that as well. You need to switch this guy at the bottom from advanced decline to accumulation distribution line. That's the indicator that Joe is referring to. If we do that, these are pretty similar. So you're not seeing that disagreement. You're seeing both of these actually go down. The reason why these are different, by the way, and go to our chart school pages if you want to know a lot of the details, but on balance volume is a Joe Granville designed indicator. It basically takes the day's close relative to yesterday's close, and the day's volume is positive or negative based on whether today's close is higher or lower than yesterday's close. Accumulation distribution looks at where we're at, where we close relative to the highs and the lows for the day. So depending on when there are gaps, you will get some differences between these two indicators. And that's what Joe, I think, was alluding to. I made a note to ask Joe a little bit more about his particular points, but that is how I would address your chart. Make sure you're looking at the accumulation distribution indicator. In that case, they're actually both overall negative, but turning higher. And I think that's what I would want to see on the chart of PayPal. Can you see further upside confirming this little bounce that we're seeing in the price chart? Next question. How can I find the members of the S&P 500 Index on StockCharts? Great question. What I would do is create a chart list. So here's what you do. If you go to chart lists and you click on new, and we say Dave's kids are great, just on the off chance that they watch the show later, they'll get a kick out of that. When you do that, at the bottom here, it says add charts to list. And this is where you can add different tickers to your list. If you click on where it says from group, we have all of the indexes and major indexes preloaded on here. So if you select S&P 500 and add charts, it will add all of the 500 members to a chart list. So what I actually do is, if you look at my dashboard, if you look at my chart list, I have a ton of them, but I actually have chart lists for the S&P 500 and the S&P 100 because I refer to them very, very often. And what I do is about once a month, I go in and I refresh the members, because the members of the S&P 500 will change, not often, but they'll change at times during the course of the year. So I have a monthly reminder to go and refresh these two chart lists to bring in the current members and make sure that I'm showing the correct members of the S&P 500 and the S&P 100. But that's the easiest way I have found to get to the members of the S&P 500 index. Our next question here. Can you share your thoughts on the S&P 500 bearish butterfly pattern? And this is the chart that you sent as I completed. Do you expect it to break down? There are others at StockCharts saying things like up and to the right just a few days ago. I'm probably one of those voices saying up and to the right. That sounds like something I would say often. And you're actually referring to a chart on our public chart lists, which is a feature on StockCharts. If you go to charts and tools, you'll find a link for the public chart lists. These are all members that maintain a list of charts. I'd encourage you to check those out. I don't know David LaRue and his work, but I was interested to experience it. So thanks for pointing me this way. And he is highlighting a bearish butterfly pattern. And you're talking about this one. So this is a daily chart of the S&P. This is a bearish butterfly pattern. If you're not familiar with bearish butterflies, this is actually H.M. Gartley was a technical analyst, very big in pattern recognition. And his work influenced people like Larry Pesavento and Leslie Juflas. And I mentioned Leslie because she co-wrote an article, a book with Larry Pesavento. Oh, I should know the name of that, and I don't. But if you look it up on Amazon, they wrote a book not too long ago talking about patterns. There's like Trade What You See, I think was the name of it. But basically talks about Gartley patterns, the 222 pattern, the ABCD pattern, and the butterfly pattern. So Leslie Juflas is a contributor to StockCharts. She hosts Your Daily 5 and is a guest on this show occasionally. I would encourage you to check out her videos because she probably could describe butterfly patterns better than I could. So actually, again, I'm not a Gartley aficionado, but I know enough because I have to know enough about everything, I guess, as a technical analyst. This can't be a butterfly pattern. You actually need a higher low. This one actually is more of a butterfly pattern where you have this butterfly looking thing, but the second low actually has to be higher than the first one. If I remember right, I think that's part of the definition. I don't think the second one can be lower than the first one. And also the thing about butterfly patterns are that there's a very specific measuring technique. So you basically take the height of the pattern, and it's like 1.236 or 1.618 times that height to get to the potential end of that leg, which I don't see being applied here necessarily. So I don't know if I could call that a valid butterfly pattern. Having said that, Gartley patterns are certainly not a core part of my process. And overall, I'm tending to follow the trends. And as long as the trend remains positive, I would say it's positive. What I would say, if you look up information on the butterfly patterns and the other Gartley patterns, they also have either a trigger, they have a stop loss, to be honest with you. So you have the entry point for a short position or whatever would tell you to sell, but you also have a stop that is built into the pattern. I'd encourage you to check that out as well. And that's what helps you, manage the risk on one of these potential patterns. So I don't know if I agree that it's a butterfly pattern, but I do see the point that we've had this extended like higher, and I would certainly, for me, I see the trend is upwards until proven otherwise. Up and to the right, as you said in your question. We need to wrap the show. Those are 3 great questions. And again, thank you all so much for sending your questions in. Keep them coming. And we'll get to them again on Friday. We need to wrap the show with a 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is the S&P 500 with 2 breadth indicators. And I wanted to highlight this one. The S&P is at top. We have the percent of stocks above their 50-day moving average, which is at 76%. We have the bullish percent index on the S&P 500, which as of today just got back above 70%. It has been below 70% since June, which is actually called a bear alert when it's positive and then comes below 70%. Getting back above that 70% level alleviates that indicator and suggests we are in a bull market phase. So both of these indicators really confirming the bull market, and it's a broad advance that we're in the midst of here. Home Depot, one of the stocks reporting earnings. We didn't get to earnings too much today, but Home Depot, Walmart, both before the open today, a number of other names, particularly semiconductors after the close, through the course of this week. I'd encourage you to check out charts like NVIDIA and others to see, and Intuit and others in the tech space. But Home Depot certainly reacting to the upside, up almost 6% today. I'm, impressed by the rally, impressed by the earnings win, but I'm not surprised by the direction of it, given the strength in Home Depot that you've seen elsewhere. So when you see the strength in consumer discretionary and the XLY in particular, remember Home Depot is a really big weight, along with 2 other stocks, Tesla and Amazon. And that gets us to our third chart in the 3 and 3, Amazon. I was talking to someone earlier this week that said Amazon may be one of the better plays because while a lot of stocks are overextended, Amazon is not overextended. And I agree with them on that second point. You could not claim that Amazon is overextended because it's essentially been sideways since August. We're at the same level right now that we were at the beginning of September, end of August of 2020. So we really haven't followed through, but we're above the upper end of that range. I'd love to see if we could hold that breakout level around 3,500. Folks, that is our show for today. A special thank you to Jesse Felder joining us from the Felder Report and sharing his thoughts. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.